Good morning, everyone, and welcome to the Vetiva Breakfast Meeting, brought to you by Vetiva Capital Management in partnership with Frontier Africa Reports. Today, our banking analyst will be speaking to us, and he'll be speaking on Fidelity Bank, a compelling player in the Tier 1 space, in the Tier 2 space. Following that, we'll get the usual rundown of the equities and fixed income markets, and then we'll conclude with headlines from across Africa brought to us by our media partners at Frontier Africa Reports. As usual, the meeting is being recorded and the audio file may be shared with third parties. We're also streaming live on our Vetiva online Facebook page if you prefer to view or join from that platform. The session is set to last for 30 minutes inclusive of Q&A. And if along the course of the session you have questions for our speakers, you can send them in using the chat function available on Zoom. If you're joining us from Facebook, you can make use of the comment section. And if you prefer to speak, you may utilize the raise hand function and you'll be given an opportunity to speak. We'll now start off with Simbiat from the Global Equities Desk, and she'll be taking us through some markets from across West Africa. Good morning, Simbiat.
Good morning, Victoria, and good morning to everyone. So like she mentioned, I'll be doing a quick recap of yesterday's equity performance across some West African markets, and I'll be starting in BRVM, where the composite index continues its uptrend, gaining 49 basis points yesterday as all indices tracking various sectors also closed in the green. A total code over followed by Solibra and CITAB all gained about 7%, closing as some of the best performing stocks yesterday. With the total number of traded equities reducing, consequently, total traded volume and turnover also declined. And today being the last trading session of the week, we expect the markets to close positive given the bullish sentiments we have been seeing. In Ghana, the market saw a significant jump as the index gained 167 basis points yesterday due to price appreciations in large cap names like MTN Ghana and Bento Oil Palm. Activity levels improved by over 500%, largely on the back of increased trade volumes in MTN Ghana and Republic Bank Ghana. We expect the market to close the week positive as investors take advantage of the low entry points in some fundamentally sound names. And like we've always mentioned, for any of our listeners looking at exposure in these markets, they can reach out to us via email at dealing@vetiva.com or to our sales team at sales@vetiva.com, and we'll get back to them. Finally, Nigeria, where we saw the market reversing Wednesday's loss as the All-Share Index gained 41 basis points yesterday. The impressive results we have seen so far in the consumer goods space continue to lift the market as the sector gained 147 basis points, which was on the back of increased demand in Cadbury and Guinness, where both counters closed limits up and were fully bidded most of the session. We also saw the market reacting positively to Transcorp impressive earnings reports. However, we saw this dwindle towards the end of the session as the stock closed up by 2.94%. In banking space, we had ETI, UBA, Fidelity, and Zenith all closing in the green. Speaking to market activity, we saw this recover from previous lows as volume and turnover improved by 96% and 37% respectively, with FBN and Transcorp both dominating activity charts. So overall, we have seen the markets benefiting from better than expected earnings results in the consumer goods space, coupled with increased buy interest as investors take position ahead of upcoming results. We expect the performance of the index in the coming sessions to be largely directed by the quality of results released into the market, while investors also take profit on recent gainers. Thank you, and that'll be all from the equities desk.
Thank you, Simbiat. Next up is Omorige, and he'll be taking us through fixed income and currencies. Good morning, Omorige.
Good morning, everybody. On the back of the settlement of the additional NTB sale of about 89 billion On Wednesday, yesterday, system liquidity declined significantly to open today at about 210 billion negative, and from the 1.2 billion negative that was seen on Wednesday. As a result of the decline in system liquidity, interbank rate tightened by an average of 20 basis points, as OBB and overnight rate closed at 14.5 and 15.25% respectively. For today, we expect the bank rate to trade at higher levels as debit from the FS retail auction and the possible CRR debit hit the system. The parallel market gained about 2 naira to trade at 568 naira to $1 yesterday, while the annual window opened at 414.13 naira to $1. The highest trade that was recorded yesterday was 444 naira to $1, while the closing rate was 415.1 naira to $1. Brent and WTI lost 12 cents and 4 cents to open today at 84.44 and $82.77 per barrel respectively. The TB's market traded on a very active note yesterday as market players try to book profit on their NTB auction winnings. We witnessed the newly issued one-year paper offered between 6.5 to 6.7% levels. From the 6.99% levels it was allotted at the last auction. Trades were majorly debt on the 8th September 2022 and the 27th October 2022 maturities. At the OMO auction that held yesterday, the CBN sold a total amount of 19 billion from an offer amount of 20 billion by keeping marginal rate constant across the three tenors on offer at 7%, 8.5%, and 10.1% respectively. The bonds market traded on a relatively muted note yesterday with bullish sentiment seen across the benchmark curve as players continue to reinvest inflows from the bond coupon payment and also react to the rate cut at the last NTB auction. There were interest on the 2027, 2036, and the 2045 papers, while trades were majorly consummated on the 2023, 2025, and the 2035 maturities. The Eurobond market traded on a very active note yesterday with persistent sell-off witnessed across the sovereigns, while the corporate space closed yesterday flat day on day. For today, we expect the bonds market to close the week on a muted note as market participants close out their books for month end, while we expect the TB's market to trade actively as players continue to book profit from the NTB auction winnings. That'll be all for fixed income. Thank you.
Thank you very much, Omorige. We have now come to the special session of today's breakfast meeting. Banking analyst Joshua Odebisi will be speaking to us on Fidelity Bank, a compelling player in the Tier 2 space. Over to you, Joshua.
Right, thank you, Victoria, everyone. So I'll be doing a quick presentation on our initiation of coverage for Fidelity Bank PLC. We call it a compelling player in the Tier 2 space in terms of a few key metrics. Fidelity Bank appears to be quite an attractive prospect, and I'll try and go the reasons for that as quickly as possible. Next slide, please. All right, so based on this, we can see that the bank's assets over the last 5 years have grown at a CAGR of about 16.71%. And as at H121, there are over 3 trillion in assets. Meanwhile, in the same period, deposits have also impressive CAGR of about 16.46%. Also is worth noting that growth in deposits has seen their CASA mix remain pretty stable. So their low-cost deposits make up 77% of their total book, which has kept cost of funds fairly stable in that period. Outside of the top 5 banks, Fidelity Bank has the highest total assets and gross loans and total deposits. And its NPL ratio of 2.8% is the lowest in our coverage universe. Next slide, please. If you can see, like I mentioned, the gross loans, the Fidelity Bank are just below all the other Tier 1 players, and you can see that their mixture for loan book is quite healthy. Of course, the largest is still their exposure to the oil and gas sector, but they also have some fairly important partnerships or relationships in the transportation sector as well, which helps to maintain pretty solid deposits and asset growth as well. Next slide, please. Thank you. All right, now doing just a quick comparison with their peers, sort of the tier 2 players in the space, minus IBTC, we can sort of that they are quite an attractive prospect, simply because, as you can see, their share price is below FCMB and UBN. However, they appear to have the highest dividend yield, at least at full year 2020, and their price earnings ratio is only 3.2 times, whereas 4.3 times for FCMB and Sterling at 3.9 and Wema at 6.3 times, but that's because Wema's earnings are significantly lower than the rest. The price to book valuation is about 0.3 times, same as FCMB. And I think it's fair to say that any bank that is trading below its book value is an attractive prospect in the long term. Their return on average equity is the highest among their peers, but their return on assets is just 1.2%, only beaten by United Bank, Union Bank. Sorry. Next slide, please. So based on this forecast, we created our model, and so we had casting forward. We expect pretty significant growth in both assets and deposits, but the gross earnings are expected to grow at a CAGR of about 9.9% to reach $3 billion by 2025. The loans, the total assets are expected to hit about 2.37 billion, and the total assets are expected to just come under 5 billion in that same period. Unfortunately, I think it's important to note that income is still the biggest contributor to their overall growth and to profitability. Their mix of trading and other income is still significantly low, especially when compared to some of the other peers. And based on their company strategy, it appears that they are fully focused on, continuing to grow and improve their interest income. However, it is still a major risk, just due to the fact that any kind of economic shocks could affect the NPLs, but they do have a very robust risk management strategy. However, overall, I think that it is important that diversification takes place and happens at a faster rate going forward. But for now, these are our projections on the historical performance and indications from management. Okay, next. So we come to the valuation. So for all of our banks, we use 3 different valuation methods, which we then blend together to get the final valuation. Obviously, we have cost of equity assumption, which is based on the capital asset pricing model, where we use a risk-free rate of 11.3% and an equity risk premium of 7.5%. Then the variable is the beta, and you can see that Fidelity's beta is about 1.32%, which gives us a cost of equity of 21.2%. Overall, our expected dividends payout for the bank for 2020, 9.6 billion in total, which gives, based on the Gordon's growth valuation, which is a simple dividend discount valuation, which just takes the future dividend and applies the terminal growth rates to get the present value of all future dividends, and then divides that by the shares outstanding to get a fair value of 3.59 kobo. Then the justified price to book valuation model, DDM, regular DDM, takes a 5-year forecast and then discounts the sum of dividends to the present while adding a terminal value, and that gives us of 3.14 kobo. While the residual income model takes just applies an equity charge to the bank's future profits to get the residual added together along with the terminal value, which also gives us a fair valuation of about 3 naira. So when blended together, that gives us a 3.18 kobo valuation, which we then roll forward by multiplying it by the cost of equity minus the dividend yield. The dividend yield as of 2020 was about 8.5%. And so that gives us our target price of 3 naira, which is a solid buy for the stock. Next slide, please. So with Fidelity Bank entering into our coverage, we now have these 8 banks, and you can see that the majority of them are a buy, except Stanbic. FBN, obviously, due to the fact that they've seen share price appreciation in recent times, and that really drove their price quite significantly. However, once they've released the 9-month results, we'll see if there's any justification, reorganizing or repricing our target price. But yeah, you can see based on our table that Fidelity solid buy is just beneath FKMB in terms of if you look at the valuations individually, you see a little bit higher than FCMB on the governance growth valuation and on the dividend discount valuation as well. But overall, the blended valuation is slightly lower. All right, that will be all. Thank you.
Thank you, Joshua. We have now come to the Q&A segment. If you have questions for any of our speakers, you can send them in using the chat function available on Zoom. If you're joining us from Facebook, you can utilize the comment section. However, if you'd prefer to speak, you can use the raise hand function and you'll be given an opportunity to speak. Okay, we have a question in the Q&A box, and it reads, please, how does the recent Eurobond raise affect the short to medium term forecast? Over to you, Joshua.
Thank you for the question. So the bank's recent Eurobond raise, they raised a bit less than they intended, the $500 million intent. They raised about, I think, just over 300 million. Overall, obviously, because of, like I mentioned, the bank strategy, majority of that Eurobond is still intended towards, their primary objective, which is to give out loans. So I think all that it really entails is that we'll see a bit of growth in their assets. So maybe the asset growth will be a little bit quicker. Overall, we also expect that will positively affect the interest income in near to medium term. And so obviously we haven't included that in our model yet until we see into our forecast. But yeah, overall that should probably provide a slight boost to interest income in near to medium term.
Thank you, Joshua. We have another question in the Q&A box, and it reads, thanks for the presentation. Is your target price on Fidelity a 1-year target price or till the end of the year? And what's your expectation for their Q3 and full year 2021 results?
Thank you. So all of our target prices are 12-month target prices from when we set them. So it is a 12 price, not just based on this, because the roll forward is a 12-month period. So it is a 12-month target price. As for the expectations for Q3, I can say that our 9-month expectation bank is gross earnings of about 162 billion and profit before of about 31.3 billion and PAT of about 29 billion, which should give an EPS of 1 naira 1 kobo overall. So still like a 44% improvement year on year in profit after tax, and a pretty much a 2% increase in gross earnings year on year. That is our expectation for 91. As for the full year, we expect the bank's gross earnings to come in at about 217 billion, while profit after tax is expected to grow to about 40 billion for full year, which gives an EPS of 139 kobo, and our current dividend per share is about 33 kobo, which is a 24% dividend payout, which is historically with what the bank has been giving. Thank you.
Okay, thank you, Joshua. We have one more question in the Q&A box, and it reads, your target price is for normal times and not the politically volatile period ahead. Please, what are your comments on this?
Thank you for that question. So I would slightly disagree, simply due to the fact that historically we've seen, we've been through a politically volatile period before in 2019, and we did not, our targets were still fairly accurate and our projections were still fairly accurate, because whatever the case may be with regards to the political landscape, the fact of the matter is that these banks have proven time and time again that they are able and capable of maintaining solid profitability. I mean, if we go back to 2019, for example, you see that their cost of risk did not go above 0.5%. And on top of that, their NPLs were also extremely stable during that period. So since that is the bulk of Fidelity's major earnings and major profitability and the efficiency, I can confidently say that whatever the political landscape may be over the next, that has been factored in, and so our cost of risk and our NPLs are still, taking those things into account, and so we are very realistic, and still, again, because our target price is period, it still fall before the election proper. So whatever may happen, so obviously we will see that reflected in the results, and we will always make adjustments to the model based on that. But I think a fair representation of where the bank is right now and where we expect it to be.
Thank you, Joshua. We have another question, and it reads, what do you consider the major drawback factor for the bank, and what part of the business needs the biggest improvement?
Question, as I mentioned in the presentation, so if we look at the gross earnings, you see that majority of it comes purely from interest income, over 70%, and they don't have that much contribution from trading and investments and from fees and commissions, unlike their peers and the larger banks who are aggressively growing their non-interest revenue in order to basically hedge against any volatilities that may come into the markets in the future. So I think that is really the biggest drawback for the bank, is their over-reliance on interest income. Although, like I said, due to their over-reliance, they have a more stringent risk management policy, and so that's their NPLs lower than their peers. However, it still remains a major risk should any major economic shocks affect their businesses. And then that is also the part that needs the biggest improvement. So they have a very strong agency banking network. However, it's still not bringing in the kind of revenue that we have seen from all the other banks, including FCMB, GT, Zenith, and the rest. But if they are able to really grow their revenue from and from their trading and investments and all the other non-interest revenue lines, positively affect their valuation and their profitability and every other thing. So I think that is the part that needs the biggest improvement, is their non-interest revenue growth. Thank you.
Thank you, Joshua. We'll now quickly take in headlines from across Africa, brought to us by our media partners at Frontier Africa Reports. Good morning, Justina.
Good morning. Good morning, everyone. Yeah, we start here from the North African region, where Afreximbank has launched a $6.5 billion general capital increase to expand its capacity to deliver on its core mandate and diversify its services. Also, the World Bank on Thursday approved a $360 million development policy financing loan to support Egypt's post-pandemic recovery and growth. Also, the World Bank approved 17 billion Kenyan shillings loan to support climate change in Kenya. IBL Mauritius says it intends to invest up to $125 million in East Africa over the next 5 years. In the Southern African region, producer price inflation jumped to 7.8% in September from 7.2% in August. That's in South Africa. As the Zambia is set to present its 2022 national budget today to the parliament, the Common Market for Eastern and Southern Africa, that's the COMESA, says it expects Zambia's national budget to support regional trade and enhance local production of goods. Also, Zimbabwe's inflation climbed to 54.49% in October from 51.55% in September. In Nigeria, a UK company, B-Box, is planning to provide off-grid solar power to 20 million people in Nigeria. And that's all from us here in Frontier Africa Reports. Thank you for listening.
Thank you very much, Justina. We have now come to the end of today's session. On behalf of Vetiva Capital Management and our media partners at Frontier Africa Reports, we thank you for joining us on our session today. We hope that you have a great day ahead and enjoy your weekend. Thank you and good morning.